Welcome to this episode of The Third Empire. Last week, the Competition Commission of India imposed a combined fine of Rs 2,274 crores on Google in two separate cases of allegedly abusing dominance. We will try and understand the reasons behind CCI's decision to impose this bigger fine. While we do that, we will also look at the private banks who have seen their net profits rising significantly in the second quarter and decode the factors contributing to this growth. You're watching Informed Investor, The Third Empire, an initiative by Research and Ranking. Let's begin. In India, trade goes on unobstructed in most cases, and the government doesn't intervene for the most part of it either. It is relatively an open economy in that aspect and also the biggest market by user numbers for US-based tech giants. Now, in a market this big, everyone doesn't always play fair, with some deliberately looking to flout rules and trying to influence market forces for their own benefit. While these practices are not entirely fair for the competitors, the ultimate impact of any anti-competitive activity in the market is borne by the end consumers, which is you and I. Now, this is where the CCI, or the Competition Commission of India, comes into the picture. The commission has a single aim of promoting healthy competition of India. It became functional in 2009, 7 years after the Competition Act was passed in 2002. The CCI believes in a single mantra: customers' interests are the only priority. While it is the Commission's responsibility to ensure that all the market players work in the best interest of the consumer, they also have the authority to ensure that no player has any undue advantage when it comes to controlling the supply of goods and services, manipulating prices, or restricting the growth of any players. So what exactly is the role of the Competition Commission of India? While the protection of consumer interest is the primary responsibility, the CCI also looks to promote and sustain healthy competition in the markets by helping establish a robust competitive environment. They have the authority to eliminate practices which could have adverse effects on competition in the process of enduring freedom of trade in the Indian markets. Apart from these, the CCI is also required to give opinion on the competition issues on any reference which is received from a statutory authority established under any law, and to undertake competition advocacy, create public awareness, and impact training on competition issues. The CCI consists of a chairperson and a maximum of 6 members appointed by the central government. So why did the CCI fine Google at all? The CCI has fined Google twice over the last week. The first order tackles Google's dominance in the operating systems or the OS market and the search engine domains. Per this order, Google was fined $162 million or 1,337.76 crores for anti-competitive practices related to Android. Now, in a probe conducted by the CCI, Google was found abusing its commanding position in the local smartphone market. Now, Android has a 95% market share. It's a real monopoly in that sense, and the mobile manufacturers are dependent on the OS, that is the operating system. So when Google decided that its Chrome browser, for example, or its entire suite of applications would come pre-installed on the Android devices to get maximum distribution, it gives Google an unfair advantage. Google Chrome specifically has a 67% market share on the mobile phones, and no one else can really compete in this space. On most devices, one can't even uninstall Google Chrome. So in summary, phone manufacturers have to feature Google's suite of applications prominently in some cases and more so in the others as well. Now, the developers are excluded entirely from distributing their own version of the OS because Google has in place agreements that prevent phone manufacturers from carrying these alternatives. Additionally, they also have exclusive revenue sharing agreements with phone manufacturers specifically catered to Google's search services. This prevents other search services from being able to even compete to Google. This, of course, prevents competition and affects user experience. This is exactly why the CCI has fined them in the first instance. The second instance focuses on the Google's App Store. The CCI fined Google for 936.44 crores on 25th October for abusing its dominant position with regards to its Play Store policies in addition to issuing a cease and desist order. Now, currently, anyone wanting to list an app on Google Play Store is prohibited from using a third-party system for billing. Google also charges a massive 30% commission on the same. Now, an initial backlash from many of the Indian developers forced Google to cut the commission to 15%. In comparison, many other traditional payment processors charge a transaction fee of approximately 1 to 3% only. Now, the developers do not have the option to do away with this restriction. It's a take it or a leave it offer. The developers can either list on the Play Store, pay the commission, which is as high as 15% compared to the 1 to 2%, and do business, or not do business at all. This restriction is not applicable on Google's own apps, however. YouTube, for example, has been given the liberty to use third-party billing systems and bypass the commission rate altogether. So this definitely doesn't make the Play Store, which is controlled again by Google, an even platform, and hence the CCI has fined Google along with issuing a cease and desist order. Now, these are the reasons behind why the CCI has imposed a combined fine of 2,274 crores and asked Google to stop imposing these restrictions altogether. Now, what is the significance of this order, you may ask? The action against Google follows close on the heels of the CCI penalizing online travel firms like Make My Trip and GoIbibo and the hospitality services provider like Oyo for unfair business practices. In fact, recent times have seen many cases related to digital markets and new age companies coming up before the CCI involving online marketplace platforms, app stores, and payment gateways, to name a few. Now, the CCI order is significant for two main reasons. Firstly, it signals a stronger clampdown on Google and the larger tech giants as a whole by the competition regulator. And secondly, it lays down India's first official stance on in-app payments by the OS operators such as Google and Apple. That said, this is not the first time Google has been fined for flouting competition rules globally. The ball on this was set rolling globally last year when South Korea amended its Telecommunications Business Act and became the first jurisdiction globally to legally ban monopolies that Apple and Google held over the payments on the in-app purchases. So what is the way forward here now? While we await Google's action and response, the CCI's judgment real impact may not be on the monetary aspect for Google as such. In both the cases, the CCI issued cease and desist orders barring Google from indulging in practices which it has deemed anti-competitive. This means that it has laid out a slew of measures for Google to comply with for operating within the country. The fine wouldn't bother Google as much as having to give an undertaking that it would change the way it does business. That would probably be one of the main reasons why Google would want to challenge the verdict in the first place. It will eventually need to comply with the CCI mandate, of course, to operate in India, but not before it exhausts all its options. Google is fighting multiple antitrust cases across the globe, and the acknowledgement of guilt in any particular region would have a cascading effect on its business globally. So will the CCI's order set a template for the big tech firms going forward? Well, we agree with that fact. The CCI's order in this month are expected to serve as a template ahead, with the antitrust regulator clearly spelling out the corrective action expected in its cease and desist orders. This approach by the CCI is intended at avoiding lengthened litigation from other digital platforms and also from extracting quicker remedies on the same. Additionally, they are also expected to guide digital companies about the activities that can be considered anti-competitive going forward. Now, the private banks have had the best quarter in years in terms of their financial performance, with private sector lenders leading the way with record high profit margins. While the chart depicts the profit growth of some private banks, we look at the factors contributing to the profit growth. The first one is, of course, the strong credit growth. Now, amidst the noise of rising inflation and interest rates coupled with the possibility of a global economic downturn, the news of a rise in credit growth in the country every fortnight is a key sign of continued growth in the country's economic activity. Now, take a look at the graph on your screen. The credit growth has been particularly strong in the recent months. Credit growth has seen a sustained rise since April this year, despite the RBI adopting a tighter monetary policy stance. This indicates that even when interest rates rise, firms and individuals continue to borrow money. Now, strong and sustained economic activity post the pandemic, the rising working capital demand, the strong push in discretionary spending, and a favorable base are amongst the factors supporting the credit growth. Now, according to the Reserve Bank of India data, the credit growth touched a decadal high of 18% in the fortnight ended October 7th. The growth is driven by retail credit, higher working capital demand amidst high inflation, and lower funds raised in the capital markets, and it is expected to remain elevated in the short term due to the ongoing festive season as well. Now, while the credit growth remains strong, deposit growth remains modest. Deposits grew at a much slower pace of 9.6%, escalating worries that weak deposit growth may turn out to be one of the major barriers to loan growth. Now, a majority of the banks that announced their quarterly earnings this month have reported high loan growth, but their deposit growth was seen trailing loan growth by a large margin, as seen in the chart below. Now, initially, banks did not raise deposit rates at the same pace as lending rates because there was excess liquidity in the system, which they used to fund the credit demand. Now, banks had enough deposits to fund the jump in the lending growth that happened over the last few months. However, with shrinking liquidity, banks have begun to raise deposit rates. Deposit rates are expected to go up even further due to rising credit demand, widening credit deposit gap, ongoing festive season, lower liquidity in the market, and elevated inflation. Now, in October last year, the credit deposit ratio of banks was around 71%, which meant that the banks had been lending around 71 rupees out of every 100 rupees that they took as deposits. However, as of 7th October, the ratio has jumped to 74.5%, meaning the banks are now lending nearly 3/4 of their deposits. This is the highest that the credit deposit ratio has been for a while. The second reason is the solid growth in the net interest income. The credit growth outpacing deposit growth has contributed to a solid growth in the net interest margins of the banks. Net interest margin is a measure of the difference between the interest income generated by the banks from the loans that they have disbursed and the amount of interest paid out to the deposit holders. The third reason is the decline in provisions due to improvement in asset quality. Every bank has to prepare for making a loss on the loans that it has disbursed. Now, to offset this credit risk, the banks estimate the expected future loss on the loans and book a corresponding provision in advance. Now, booking a provision means that the bank recognizes a loss on the loan well ahead of time. All major private sector lenders that reported their July to September earnings saw their provisions drop. This was due to the significant improvement seen in both the gross NPAs and the net NPAs, which declined year on year during the period of July to September. While these trends have contributed to a strong quarterly growth, the outlook going forward continues to remain strong. This is on the back of the ongoing economic expansion, the rise in the government capex and the gradual pickup in the private capex as well, the rise in the capital utilizations, and the extension of the Emergency Credit Line Guarantee Scheme, or the ECLGS, for the MSMEs. That said, the downside risks to credit growth cycle would emerge from the widening gap between deposit and credit growth, which we've already spoken. While most of the major banks saw margin expansion because of the transmission of the rate hike, which was quicker on the asset side than the liability side, the banks are now set to increase the deposit rates further to garner more liquidity into the system. In fact, many banks have already started raising their deposit rates. Therefore, the high margins could see an impact as the deposit rates catch up with the lending rates, resulting in some moderation. So while the profits have indeed soared on the back of a healthy loan growth, higher margins and better asset quality, the private banks are currently poised to continue their dream run well into the next financial year. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.